In this video, we are going to talk about life insurance. Here's an introduction, and let's define life insurance. A person purchases a policy by paying a premium, and the insurance company promises to pay a sum of money at the time of the policyholder's death to the designated beneficiary. If an endowment, then the amount is paid to policyholder while living. There is some ways where you can collect a value of the life insurance while you're still alive, and we'll discuss that a little later. In other words, in short, life insurance, the most basic form, it's money that gets paid to survivors of person that died and they are the beneficiary. Purpose of life insurance: protect someone who depends on you from financial loss related to your death. Now, this first bullet is probably the most important thing that you need to think of about life insurance. You typically come across agents recommending that you buy life insurance. But the first question is, do you want life insurance? If there is no one that depends on you financially, then you may not want life insurance unless you just want to leave money as a gift for somebody that you care about. Because remember, the money is not for you, it's for somebody that's still alive after you die. The number one reason will be, let's say, your family members, let's say spouse and kids, for example, that depend on your paycheck at your job. So all of a sudden, you're not able to provide that paycheck anymore. Then life insurance kicks in to cover that financial loss. Proceeds may also be used to pay off a home mortgage or other debts at the time of death, provide a lump sum payments to children when they reach a specific age. Those are some ways to do it. Provide an education or income for children, cover medical expenses and funeral costs, accumulate savings or establish income for survivors, make estate and death tax payments. It doesn't mean that this is the only way you can do it. These are examples of way you can assign. But it could be just, here's the money. I do whatever. What a lot of people do is that they set up certain rules of how the money can be spent to make sure the person receiving the money it will benefit properly from it and doesn't squander it, which may happen. Principle of life insurance and life expectancy. So the principle of life insurance: mortality tables show the number of deaths among various age groups and gender during any year. In other words, it's used for stats. How they collect premiums has to do with the stats of the death rates. Life expectancy: individuals are living longer due to improved medical care, healthier lifestyles, and education obtained. Women do outlive men. This is important because for many reasons, but if the insurance company, for example, one of the key ones, can collect premiums from a person for a longer period of time because they're living longer, then that's good for the insurance company. They might be able to bring the premiums lower. That's just one example of many of how those things become important for them to calculate. Estimating your life insurance requirements. So how much life insurance should you get? Should you get $1 million? Should you get $10 million? Should you get 200,000? So these are just a few examples, but there are many, many ways to estimate how much you want or need. Some people, after the calculation, go like, let's just add more because. So the multiple of income method, so we say that needs range between 5 and 8 times your annual income. So if you make $100,000 a year, then you, under this method, you will consider between $500,000 and $800,000. The easy method, typical family needs 70% of your salary for 7 years before they adjust to life without your income. The first one was also easy if you think about it. This one here is if you make 100,000, a year, then 70% will be 70,000. Multiply that by 7, that puts you at $490,000. And that would be the amount of insurance minimum that you should consider. Then there's the DINK method. DINK is just dual income, no kids. And the idea of this one is that you both work. That's a dual income part, and no kids. So there's no additional expenses. So let's assume in a scenario that you both made about the same amount of money, meaning that ideally each one of you is covering about half the payments and debts, half the mortgage payment, half the credit cards, half the car payments, etc. So what you do is you calculate how much funeral expenses would be, then add half the debts for X amount of years, or that's if you do by payments, or just the total debts, cut it in half. So in that example would be funeral expense, let's say $10,000. I don't know. I just made that number up. It could be more. And your mortgage, cars, credit cards, and everything adds up to about $300,000. So if you take the $300,000 plus the funeral expenses, divide that by 2, that's how much life insurance you should get. And then when that money comes in, you pay half the debts and you pay the funeral expenses. Estimating your life insurance requirements. So here's other methods. The non-working spouse method. Multiply the number of years until the youngest child reaches 18 by $10,000. So if you have a child that is 12 and all one is 8, then what you do is that's 10 years by 10,000, and that would equal $100,000. That may sound low. It just really depends on the specific situation. The family need method, more thorough because it also considers employer provided insurance, Social Security benefits, and liquid assets. So this is definitely a more complex need, but it's tailored to each individual case. So, and by more work just means you got to do a little more listing of your needs and your expenses and all that for so many years. It's not that much more work. It's just more work than the other simple ones. But it will be better suited to your specific needs. Online calculation applications, sure. Right now on the internet, there's all kinds of, some of them are really quick and fast. Some of them have a questionnaire that you fill up a few items and they tell you a suggested amount. Types of life insurance companies. Okay, here we go. So you got stock life insurance companies are owned by shareholders. 71% are of this type. This is the most common life insurance company out there. Sell non-participating policies. If you want to pay the same premium each year, choose a non-participating policy with guaranteed premiums. So once you enter the contract, they say this is how much you pay. It's not going to change over the years, and this is your benefit. Now, if you change the benefit, the amount, then sure, expect your premium to change and be updated accordingly. You got mutual life insurance companies. This is the next item, the next type of company out there. Notice they're not as popular as other ones, but still significant. 29% are of this type. It is owned by the policyholders, which is different from the stockholders. And they sell what they call participating policies. Higher premium than non-participating. But part of the premium is refunded to the policyholder annually. Refund is called the policy dividend. So because you as a policyholder or owner of the company, you can get some of that money back. Now, and sometimes that policy dividend may offset the higher expense premium till we get a better deal. Sometimes does not. It just depends on what happened that year. Types of life insurance policies. You got temporary. It's called term also, if you hear out there, renewable term, convertible term, or decreasing term insurance. So it's not all your life. Some people, what they do is they say, well, I'm only want to have life insurance for the next 20, 30 years. That's while my kids grow up and start and go on and get their own life and their own jobs. And then they'll say, if I die, my pension will take care of my spouse. That'll be an example of a person that will go for temporary. Then you get the permanent insurance called whole life, straight life, ordinary life, or cash value life insurance. At the end of the day, it's just you are covered until you die, no matter how many years that is. And then when you do die, then the beneficiary gets the money. On term, after that 20, 30-year process, you're not covered anymore. So if you don't die during that time, then you're fine. You don't get, I'm sorry, the beneficiary does not get the money, but at that point, they may not be people that are dependent of you financially anymore. Then we have more details here on the term life insurance. Protection for a specified period of time, as I mentioned. If you stop paying premiums, coverage stops. Renewability option, renew the policy at the end of the term without a medical reevaluation. So let's say you said 20, 30 years, but then 20 to 30 years go by. You're much older now. And sometimes it becomes an issue to get insured after you have reached a certain age. But if there's a renewability option, they just continue. Multi-year level term, popular because you pay the same premium for the life of the policy. Life insurance, conversion option, can exchange term policy for whole life policy without a medical examination. We're not saying that all term life insurance policies are that way, but some do offer that option. Decreasing term insurance premium stays the same, but the coverage decreases as you age or debt is repaid if paired with a mortgage. We'll talk about the credit insurance in a minute, but what it means is that you keep on paying the same premium, but as you get older, the amount that you collect becomes less. This typically results in a lower monthly premium because the risk keeps on dropping for the company, but something to consider depending on your needs. Whole life insurance, as we mentioned earlier, is pretty much permanent life insurance. This is all your life. Is called straight life or cash value life of ordinary life. So you're covered not for a specific period of time, but it's all your life until you pass. You pay specified premiums as long as you live. The premium depends on your age when you start the policy. So it might be it's going to be a fixed amount for your entire life, but the younger you start, the lower that monthly premium will be. Provides death benefits and savings account. So what the meaning is accumulates a cash value. You may have heard of this. Have you ever heard of life insurance before, where there's a cash value that you can collect or pull out the cash while you're still alive? Makes sense if you intend to keep the policy for the long term or must be forced to save. What they mean by first the policy for the long term, meaning that you already thinking of a very, very extended period of time. So term insurance would make sense. And the other one must be forced to save. Well, some people do not have the discipline to save. This will save for you because you cannot just withdraw money as simply as that without having an impact on the life insurance itself. First, consider other savings and investment options before investing in whole life insurance. This is where some people debate. If this is what happens, let's say you start life insurance, even if you're young and you pass away and you had a spouse and kids, then yes, having life insurance made more sense because a large amount of money will be collected. But since the probability when you start young of you dying soon after starting your premiums, it's low. So the idea is that these premiums could have been invested on standard retirement plans or other tax benefit plans or just a regular brokerage account. And that over a period of time, there will be much more money in that account that what the insurance would pay. So it's a trade-off, and it's a time trade-off. The longer you expect to live, you're better off by investing the money. If there's a short life expectancy for any reason, which is an irrational fear, and it does happen, then you are better off paying premiums. But nobody can predict the future. Just understand the opportunity cost. Whole life insurance, you got limited payment policies versus modified life insurance policy. The limited payment policies pay premiums for a stipulated period, usually 20 or 30 years, or until you reach a specific age. So you can say, I will be covered until I die, but I'm only going to make payments for this amount of years. Now, trust me, they're going to get their money one way or another. They prefer that you make larger payments for a certain amount of year up front, because that they get that cash flow up front. And then they just wait until you pass to pay the benefit, versus stretching out the payments because they get less cash up front. Your policy then becomes paid up and you remain insured for life, face amount paid at death. Modified life insurance policy, attractive to people who want whole life policies but find the premiums too high to handle on their current budget. So then you just modified those payments. Because as I mentioned, you're in the fixed amount of years, then you're going to have higher premiums, but it covers you. Whole life insurance typically allow lower premiums for 5 to 10 years, and then the premiums will increase significantly for the remainder of the life of the insured. So two things are the logic here. One is that as you're younger, you might be able to afford higher premiums, but they want you to get they want, be able to cover you now in case something happens. But as you age, because the risk of you dying increases and you make lower payments early, then your payments go up. But at that point, you might be able to afford them better because you got promoted, you have more income, for example. Variable life policy, minimum death benefit guaranteed, but cash value is not guaranteed. As we spoke about in the whole life insurance game, there's a cash value that they can guarantee as you make payments. Here they're saying is, yeah, you'll get your benefit, but the cash value may vary from year to year. Why will somebody do that? Is because that variation could be less than expected, or it could be more. So you might end up with more cash value than you would on the fixed one. The death benefit can be greater than the minimum depending on earnings of the dollars invested in a separate stock, money market, or bond fund. And that is the source of that variability. They're saying that your benefit and cash value is dependent on the performance of the way that money was invested. However, the minimum benefit will be guaranteed. There'll be a minimum. They say you'll get this no matter what. The rest will be above. Adjustable life insurance policy. Whole life insurance policy, but you can change your coverage by changing the premium payments or the period of coverage. So you can adjust. Pay more, get more, pay less, get less. Universal life gives more direct control, can pay premiums at any time in almost any amount. Amount of insurance can be changed more easily than a traditional policy. Very flexible, very flexible. But everything comes with trade-offs. And so more on whole life insurance. The increase in the cash value of the policy reflects the interest earned on short-term investments. That's pretty much what we spoke about earlier on that variable part. The money gets invested and the performance dictates the cash value. Combines term insurance and investment elements, which is what we've been explaining this whole time. Other types of life insurance, group life insurance. So you can get a bunch of people together and you can go ahead and bypass a medical examination. And it has to do is that because it's a large group coming together, it spreads the risk appropriately in order to get that. It comes in form of term insurance. It's only for a period of time, often provided by an employer. It depends on the benefits offered in your company or where you work at. Endowment life insurance. provides coverage from the beginning of the contract to maturity and guarantees payment of a specified sum to the insured, even if it's still living at the end of the endowment period. I guess one way to think about it is like the term life insurance, a 20-year deal, where if you die between those 20 years, there's a benefit to be paid. But let's say 20 years go by, and I don't want to say it's similar to the cash value, but it is, you get the payment at the end of the period that you agreed upon at the end of the period. Credit life insurance used to repay personal debt such as a car loan if borrower dies. Many times when you borrow money, mortgage, car, student loan, it depends on the provisions and who you borrow from. One of the fees is a life insurance to cover that loan in case you die. And it's expensive protection, considered a ripoff. The reason is, first of all, just being expensive. It's already a bad sign for what you get. And part of the reason is when you die, debt does not get inherited. It has to go away. People are not responsible unless they co-sign the loan. They're not responsible. Now let's clarify some caveats here. Let's say you have a mortgage loan and you die and you're the only one signed for it. Well, that loan, the bank has the right to get the money from the sale of the house and pay back what's owed, and then anything over that then can be inherited down to the people. So there'll be a way of where the debt is covered by an asset. So in that case, that has to be repaid through the asset first, and then whatever's left can be passed on to the survivors. But let's say credit card debt, signature loans, anything that is not secured by an asset, and you die, that's it. Nobody else co-signed for it. It has to be written off. So what they do is they add these life insurance policies to cover that debt, but those are very expensive premiums. On the other hand, if you need to get that loan, then you have to agree to it. If not, they won't give you the loan. So it's one of those things. Industrial life insurance, known as home service or debit insurance, premiums collected at insured's home, and this is the least popular. Comparing policy cost, 5 factors affect the price of a policy. So the company's cost of doing business. Okay, so we're talking about not the company you work for. We're talking about the insurance company itself. If they have operating cost. So remember, this is still a business. So they got to charge you something that covers all their cost of doing business and a profit. So unfortunately, sure, smaller companies are going to have more, probably a larger margin on overhead and cost. So they have to cover that first. So the premium is going to start from there. So return on the company's investments. So back to what we mentioned earlier about the money gets used by the insurance company to invest in securities. So if they have a good return on those investments, for example, then they're bringing in money that way, so the premiums can be kept low to bring in more people. But if not, then it has to be thrown in the premiums because they have to stay in business to begin with. Mortality rate the company expects among policyholders. So while there's some average mortality rates, you still have to do the statistics on the actual people that you would be paying if they die. So they have to grab their own pool that becomes their own risk pool. And they had to see, so a company that has a lot of, I say older people, then the risk of having to pay off a lot of these policies is very, very high. So their premiums are going to reflect that. Policy features. Well, what are the features in the sense of, well, is it variable? Is it not? How much? How long? And all those little details we spoke about that go in the policy. But that's common. That's nothing out of the ordinary there. Competition among companies with comparable policies. As you may have learned or will learn in economics classes, competition brings prices down. That's pretty much the short way of saying that. Underwriting uses many attributes of individuals such as age, gender, health, occupations, and even hobbies to determine the appropriate premiums to charge for insurance. So let's talk also about you as a policyholder. Somebody with a high-risk job where death is high risk, then will have a higher premium than somebody with a job that has a very low risk of death. Common settlement options: lump sum payment, pays face amount in one installment. If you're insured for $1 million, they give $1 million to the person, done. Proceeds left with the company, pays interest to the beneficiary. So I mentioned earlier that some people cannot be trusted with a large amount of money to use it wisely to be set financially for the time they need. So what they can do, the policyholder says, no, hold on to the money. What you do is you make these payments to this person periodically. Limited installment payment, pays equal installments for a specific number of years after your death. Okay, very similar to the previous one I said. However, the previous one, it's based on the performance of the investment. So it's more of an interest payment, and it can be last the entire life of the beneficiary. This limited installment payment, then what it is, so many payments, so many years, then it stops. Life income option, payment to the beneficiary for life. It's an annuity, very similar to the proceeds left with the company, pays interest on the beneficiary. However, that second bullet may be dependent on performance. So the payment could go up or down. That will be one of the differences I'm going to talk about versus an annuity, which is a fixed amount, same amount every month or year, however the guest is getting paid for the rest of the life of the person. So it's fixed. Now, typically, on average, the total annuities will be end up being a lower number than the payments of interests. But that's because the payment of interest has more risk associated, more volatility, has ups and downs. Annuity is fixed and guaranteed. Income from life insurance policies. Insured of a whole life policy may borrow against cash value or surrender policy and receive cash value. Yes. So as we mentioned earlier, there's a cash value associated with a whole life insurance. You can make loans against it because it's an asset you have, or you can say, all right, no more policy. If I die, I die. But let me get that cash value and just take the money out. People who purchase variable life insurance policies may supplement retirement income by withdrawing some of the investment portion as an annuity. What we spoke earlier about the variable piece, that the money is going to get invested and your cash value and your benefit is going to fluctuate. What happens once you're retired, that piece of the money that comes in from the investments, you can, for example, withdraw some of it to supplement your retirement plan. Switching policies. Yes, be careful when you do this, because remember, you only get older with time. So switching policies, then the renewability of the policy is not the same. And whoever you switch to is going to start fresh, like if you just got there. So if you start a policy when you're 25, you can renew that one. And if you got the renewability option, you're 50 and no problem. But if you try to switch policies when you're 50, you're not going to be treated the same way as when you were 25. So be aware of that. So you first want to check, well, can they still insure you? You want to check that if you can get insured at all by some other company before you drop the current one you have, because after a certain point, some health changes or life, things that happen in life or just your age, you may not be able to get a new insurance policy from a different company, period. The older you are, the higher the premium will be. Can you get all the provisions in the new policy that existed in the old policy? Well, that's not as important. You may not want or need the same provisions, but if you do, you want to make sure you can still get them. And ladies and gentlemen, that's it for this video. See you on the next one.